Okay, ladies and gentlemen, my dear PFA families, guys, welcome to tonight's call. Happy New Year, Happy New Year, Happy 2020, guys, and very excited to be your host tonight to go over this extremely important training going into this brand new year right here. Okay, so I'm sure that a lot of you guys have heard about the Living Life by Design training, especially in the last 60 days of 2019. But this training is going to be in depth. All right, we're going to go, talk about things that you probably may or may not have heard about in the past, and I'm going to use my field experience to also share with you some of the things that you may never heard about from our carriers training, so to speak. Okay, so with that being said, guys, again, thank you very much, and with that, let's go and get started. And I'm going to give you about 30 seconds or so to read through this disclaimer. All right, so basically what it says is all these trainings are for internal training only, absolutely no posting on any screenshots in the public media, okay? And of course, I do the best I can to put together this information, but of course, there could be human error, right? And a lot of these things also are from my own experience, my own opinion, so to speak, okay? So that's what these disclosures are for, to protect me and to protect the company. Okay, so with that, let's go and get started. Within the next 60 minutes or so, we're going to talk about a lot of things, all right, within this particular product, and my goal is to make sure you're going to be well-trained, well-equipped, and have the confidence to go into 2020. We're already in 2020, but more so to have the confidence and the knowledge and the expertise to go out there and serve your client to the best of your capability because you are equipped, and also to be able to train your team member at the best of your capability because you know what you're doing, you know what you're talking about. All right, guys? So, and again, what differentiates a mediocre sales guy versus an expert is of course the knowledge you possess, and most importantly, the implementation of the knowledge you possess. Okay, and I always use the car buying example. You know, if you're gonna go out there and buy a luxurious vehicle, right? I mean, today maybe a Lambo, you're gonna spend $300,000 to buy a Lambo. I absolutely can assure you, at the end of the day, if you got presented this Lambo, same model, everything's the same color, same feature, but one is presented by a person that knows 90% about a car, the other one is presented by a person equally likable, but he knows 100% of the vehicle. You're going to end up buying from the person that's more knowledgeable. Okay, so the whole idea is not just to know the superficial, the surface of this product, but at least become the expert, or at least your certified field trainers who's on the field training your clients and training your team members ought to be the experts, okay? And some of us may or may not want to be the expert. That's fine. You want to be the recruiter, but you and your team got to have the CFT that possess this kind of knowledge so that you can serve your clients and your team absolutely the best, right? So we're going to talk about two categories, two things today: all the death and living benefits protection riders. So the first thing, we're going to talk about all the riders in depth about the protection side of the product. Okay, and there's of course the death benefit as well as the living benefits. And then we're going to wrap it up on the second half of this training on more so on all the riders on the cash accumulation side of the product, also in depth. All right. Now, Living Life by Design is a proprietary product exclusively to you, to us, to PFA Associates. So you should be very, very proud of that. Okay. This product is truly designed for you to be able to do multiple things for you, for your consumers out there. For example, provides death benefit guarantees. All right. It provides cash value accumulation, downside protection of the cash value. It's got retirement income strategies, business planning, business succession planning, wealth transfer, charitable giving, all right, along with the death benefit and the living benefits, of course. So, you know, one way to describe this tool or this amazing proprietary product, it's the Swiss Army knife in the financial or in the insurance industry. And may or may not know about Swiss Army knife, but it's one of my favorite tools. Literally, you know, one little powerful tool that's multiple purposes can be served. And inside of this Living Life by Design, you are able to do a lot and many great things for your clients out there, okay? Now, first and foremost, this Living Life by Design is a, you know, spanking new product, literally fresh off the oven, so to speak, you know, at the end of last year. And therefore, it is incorporating the newest CSO mortality table, okay, Commissioner Standard Ordinary mortality table. So to make things very simple, going forward from now and on, you know, pretty much the whole entire industry are using this updated mortality table now, okay? It's literally better rates, better fees in terms of cost of insurance for your clients. Now, you know, I just want to briefly talk a little bit about this, and before I do that, I want to share with you very quickly comparing the current new CSO table, which is what you're seeing right now, versus the old one, which no longer existing on the field. Nobody can sell it anymore. You can't even run illustration using the old one anymore, but just the comparative purposes, so that you know what I'm talking about, is that if you compare the new one on your left-hand side versus the old one on the right-hand side, you immediately see that giving everything's the same age, same premium, same health ratings, same sex, same duration of payment, same death benefit, you'll realize the cash accumulation is higher on the left-hand side using the new CSO table at different age. Okay, so that concludes the you know, I guess the question of whether or not it is better for the consumer. Is absolutely better because it's cheaper. Okay, now it's very interesting that you know, some of us may have seen some online posting online, especially in the past, towards the end of last year. A lot of people saying that, you know what, hey, you know, buy an IUL now, buy your life insurance now before it turns to 2020, because things are getting more expensive. You should get in now. I don't know how many of you guys have seen those kind of postings floating around. I've seen many of those, but I want to correct that, you know, once for all on this call, so that you'll be equipped, so you know you will have the right knowledge. Okay, the fact of the matter is that consumers that's buying life insurance using today's CSO table are better off because they're cheaper. All right. So, in contrary to what some of those marketing posting are saying, oh, it's more expensive, it's completely entirely false. It's not correct. I mean, I'm sorry that some of the people, you know, in the industry has to do that to get a client go in and try to buy the policy in 2019 instead of 2020, and they try to cause this what I call sense of urgency, but it's entirely unsupported, so to speak. Now, what was true, was not stated clearly, was that because the cost of insurance are cheaper today, when you bought a 2019 policy because it's more expensive, therefore the guideline level premium in the old CSO table was higher. So what was true was if you bought an old policy before 2020, you are able to put more premium into that policy. Not cheaper. All right? I want to make sure you understand that. Not cheaper for the cost of insurance sake, but you can overfund it on a premium level wise higher, which that was true. And of course, when it comes to IUL world, when you can put more money into IUL, you more funded IUL, the result should potentially be better. So that was indeed correct. But a lot of people somehow, unfortunately, tweaked it or deviated from the absolute fact and make it sound like what it truly isn't, but more for a marketing purpose. Okay, so enough said about that. So consumers have benefited from this new CSO table, period. And with our Living Life by Design, ladies and gentlemen, we are also including a higher face amount for easy underwriting. And right now, from age 18 to 50 years old, you can literally get easy underwriting up to $2 million in face amount. It used to be $1 million, and now it's $2 million. And this is fantastic. Now, when I say easy underwriting, it means no fluids. All right, no fluids, no blood. I've got a case submitted recently, over $1 million. Okay, and literally, it was in the holiday season, and I don't expect anything was going to get done. But literally in 72 hours, I got an approval. Kid you not, okay, without any fluids whatsoever. So easy underwriting at the end of the day is going to be very, very much beneficial to your client and cuts down the underwriting time, save the company's money. The client would be happy, and also in the agent's point of view, you are getting paid much, much sooner than later, okay? So that's a great thing. And now all the way up to 65 years old, you can get easy underwriting. And of course, the face amount is different depending on the age of the client. All right. Now, Living Life by Design, ladies and gentlemen, we're talking about their it's a product that can do a lot of things, right? It can do a lot of things good, not just do a lot of things, but can do a lot of things great. And because of that, the product has a lot of different riders, right? And today, for the purpose of this training, you're gonna learn this in depth. Okay, so you're gonna be able to find out, number one, what are all these riders? What do they mean? What are they used for? And number two, should you use it or should you not use it? Under what circumstances are you supposed to use it? Right? So this is a list on the first page. Accelerated benefit rider, balance sheet rider, children term rider, all the way down to waiver riders. So we're gonna go through each and every one of those plus more. All right, and this second page completes the list. You got the premium deposit account system allocation rider, additional protection benefits, unemployment rider, loans, credit strategies, accumulation value enhancement rider, overall protection rider. So what I have given you here is the complete list of riders and features on Living Life by Design. Okay, so in hope that by the time you finish this training, you'll be confident. All right, you become the next expert as to how you're going to use this, financial Swiss Army knife, because there's a lot of knobs in there, right? What you should add, what you should not add, under what circumstances. That's very important to understand. Okay, so now let's zoom out a little bit, and let's kind of zoom out and look at the big picture. Why we are doing what we're doing? Okay, why we have been so successful doing what we're doing? Well, simply because we've got a crusade. We have a vehicle that allowing each and every one of us to go out serve our community, our masses, basically satisfying and fulfilling these three needs: dying too soon, living too long, or getting sick, right? So we have one product that solves these three major concerns that every human being is thinking about every day, right? Dying too soon, living too long, getting ill, right? They're thinking about it, but many, many people out there do not have the solution, and you do, right? And that's making us very successful, and then by benefiting our consumers out there, right? So let's talk about the protection side of things here real quick, okay? For the first half, let's kind of zoom in the details of protection side of it. And for protection side, we're talking about death benefit, and we're talking about living benefits. Of course, what makes our product super unique and powerful is our living benefits, right? Life insurance, you don't have to die to use. So what this policy does is allow you to access the death benefit, right, in the event of terminal, chronic, critical illness, and critical injury. Okay? So sometimes you see acronyms such as ABR, and that just simply stands for Accelerated Benefits Rider 1, 2, and 3. Now, ABR 3 it's a combo of critical illness and critical injury. Okay, Okay, so that's how it's being defined in a policy. But what are they? Well, terminal illness advances payment under certain circumstances on a discounted basis. Now, notice that all this living benefits that you do get besides the reason of dying, they're always going to be discounted. They're not going to be, the full entire face amount. That's what I mean by discounted. Okay, if you've got $1 million death benefit, and if you want to use it for terminal illness purpose, it will be less than $1 million. Okay. So the definition of terminal illness is the death results in within 24 months. All right, that's what terminal illness stands for. Now, some other states such as Connecticut and Pennsylvania and Vermont, their definition is slightly different. Okay, so you do have to be careful. Really depending on the so that's why you need to really understand and read through the state underwriting guideline, product brochure thoroughly, because each state they do vary a little bit differently. Okay, for example, terminal illness is defined slightly different. Now, for terminal illness, LSW will accelerate income tax-free the discounted death benefit not to exceed lifetime maximum of $1.5 million per insured. Okay, so that is the maximum up to $1.5 million, regardless how big your life insurance is. Make sense? You got $10 million death benefit, but if you want the money now versus death, the maximum you can get in your hand while you're alive, it's $1.5 million. Okay, so this is pretty straightforward. Nothing too exciting about this. Many insurance companies have terminal illness rider, but what they don't have is the generosity of the definition. We say 24 months of life expectancy. Many companies says 6 months or 12 months. We're 24 months, so a lot more generous, and we give up to 1.5 million. Many other companies, give up less than that, maybe $500,000 or maybe $250,000. Okay, so you got to know the difference also. All right, let's move forward. Next one is chronic illness. Chronic illness is has to be certified, within the past 12 months by a licensed healthcare practitioner as being unable to perform without assistance at least 2 out of 6 daily activities. Okay, and these 6 daily activities are defined as eating, toileting, transferring, bathing, dressing, and continence. And cognitive impairment may also qualify. And if you do qualify, you'll be able to get 2% of the net discounted death benefit per month, or 24% of the net discounted death benefit annually. And the maximum lifetime amount is up to $1.5 million. Okay. One thing I do want to point out in the fine print is that what makes our chronic illness benefits very special, very unique, is the fact that it is not a reimbursement benefit, meaning that we don't require the client to go to have a long-term care service done, or maybe have the nurse come and visit your house, service being done, you get the receipt and you turn it in, and then wait for like weeks or months for the insurance company to send you reimbursement. No. Doesn't work like that. Our is a direct payment. All right. If the client qualifies it, the money goes into your bank account, goes to your pocket, and you can take the money. You can use it for nursing home. You can use it for a long-term care. I don't know, a helper that comes to your house to help you to bathe and food and feed you and whatnot, and help you to walk. Or you can use that money to travel around the world. Right. So that is what's making our living benefits, especially chronic illness, so powerful because of the flexibility of it. Now, the waiting period now is only 30 days for all the states now. Okay, so meaning that once your policy gets issued, you just need to wait 30 days from the time it issued, then this chronic illness rider becomes effective. All right, that means that it is there. In the past, it was much long. In some states, it could be as long as 2 years. So in the first 2 years, if you get ill, if you get chronic ill, you can't even claim it. But now you don't have to worry about it anymore. Until 30 days from time issue, this rider becomes effective. However, what's important for you to understand is once the client has symptoms of chronically ill, the 2 out of 6 daily activities, or cognitive impairment, it has to last 90 days, guys. Okay, so you cannot make a claim just day one after they have the symptom. It has to at least for 90 days and consecutively, and the client has that symptom for that period of time, and now they are eligible to start making a claim. Okay, so it's important for you to know. It's important to also discuss that and disclose that to your client very, very thoroughly. All right, so that's your chronic illness. And the third and fourth one, we'll lump them into one called the ABR3. The critical illness, critical injury, clients can request a full acceleration or partial acceleration of the policy death benefit in the form of lump sum amount not to exceed lifetime maximum of $1 million. Now, you probably remember terminal illness maximum is what, 1.5, and chronic is 1.5. Critical or critical injury is up to 1 million. Okay. The level of discounting applied to death benefit varies depending on the issuer's age and the severity of the critical illness. So they all going to be discounted again. So you're not going to get the full face amount what you had in the policy when you first applied for. It'll be less than that. But again, how much less? That's the discounted factor. How much less is based on the severity of the illness, right? For the critical illness claim we're talking about, how severe it is, and then how long you've been paying the policy. Now, before we talk about that, these are the 13 triggers: heart attack, stroke, cancer, end-stage renal failure, major organ transplant, ALS, and blindness on the left-hand side. And on the right-hand side, I'm not even try to pronounce that, but there's the other 6 additional triggers that you'll be able to make claims for your critical illness. Now, the reason I put the 7 on the left-hand side, make it green, is because these are the ones that's available in the state of California. Now, it's a big state. We do a lot of business in that state, so I just want to make sure you understand. In California, we only have 7. But for the rest of the country, you guys, or most of the states, I would say, I wouldn't guarantee that every other state has these 13, but for most of the other states, you guys have all 13. Okay? So again, it's important that if you're going to sell in, for example, I don't know, Illinois, well, take a look at Illinois. Make sure you run the illustrations, all right? Look at the brochure. The illustrations on that software will always tell you what is available, what is not available, all right? Or New York, or Maine, or Wisconsin, okay? So don't assume, but always make sure you run the illustration, look at the state-specific brochures before you even quote a client. In other words, just be fully prepared when you go see the client. And part of the critical ABR3 is critical injury, and that's defined as coma, paralysis, severe burns, and traumatic brain injury. Now, by the way, this is the critical injury. It is very unique to National Lide Group, and no other company or very few other company even have something similar to this. Okay. Now, in terms of the discount, how much of the original face amount are you able to accelerate in case of illness? It's really depending on the class of the illness when it comes to critical illness. Okay, so it's minor, you get a little, the smallest amount. Moderate, you get a higher amount. Severe, you get higher, and life-threatening, you get the most. Now, who decides that? Again, a third-party health professional or your doctor that decides whether you're minor or severe or life-threatening. Okay. So based on the degree of illness and based on the age, how long the policy being enforced, payment being paid, that determines how big or how small that discount will be. So make sure you understand that very clearly as an agent and as a client, right? That is how living benefits always being paid out is going to be discounted. Now, I want to show you something that's very interesting without knocking on other companies specifically, all right? Because we got to stay professional, right, in this field. However, it is important for you as a consumer and as an agent understand not all living benefits are created equal. They're not. As a matter of fact, they could be so different that one company's living benefit definition could be 180-degree different from what we do in here. Now, this is a specimen or a copy of a very, very recent product from a major issuer. Major, I'm talking about one of the biggest out there, okay? And they, of course, claims that they have critical illness, accelerated death benefit, which is absolutely fine because that is a trend, and a lot of insurance companies these days are getting on board, and they try to do the same thing because they try to be competitive or stay competitive, right? But when you look at their specimen, when you look at their brochure, and if you are experienced enough to know where to find it, it literally takes you probably less than 60 seconds. You go into the big brochure, and you'll be able to highlight some of the details. So I've highlighted some details, and I looked at their critical illness, accelerated living benefits, and I found something that is super important and very, very different than what we do in here. Now, their definition of critical illness means the insured, critical ill means that the insured has been diagnosed after the rider date with a medical condition that would, in the absence of treatment, result in the insured death within 12 months. That is the definition. Now, when I read this definition, a couple of things that come to my mind. One is, wow, who is going to certify that your disease is going to be so untreatable, and in the absence of treatment, you're going to die in 12 months? And number two, this sounds more like a terminal illness definition than a critical illness to me, right? Because that's what our terminal illness is. That, hey, if you're sick, the doctor said, well, you are incurable. Even with treatment, you're going to die within 24 months. This thing says, in the absence of treatment, a little bit different than terminal. I will have to say that. But in the absence of treatment, you're going to die within 12 months. Now, this is completely different than ours, right? I mean, if you look at our definition is these 13 triggers, right? I mean, very well defined. Plus these 4 triggers, very well defined. And they just need to know if it's minor, moderate, severe, or life-threatening, and that's it. But their definition is this. So the reason I want to point this out is because there's so much opportunities in 2020, guys. The main reason, and I tell you the main reason that I am more passionate than ever, even after I've been in the industry for 20 years, and today feels like I'm just starting it. Today feels like, the last 20 years is preparing me for the next 10 years. It literally, I'm like just a new kid on the block. It's because there's so many people out there in the world, in the country today, need your help. All right? So many people out there don't have living benefits. All right? If they get sick today, they can't touch the money. All right? They have to wait until they die to touch the money. And there's so many people out there today perhaps got sold a policy that they promised living benefits, and they don't even know what kind of living benefit they have, and they will find out exactly what you see right here. When they get sick, and when they have heart attack, and they thought that they're going to be able to claim, and it turns out when they make the phone call, make the claim, they will ask him, well, are you going to die within 12 months? If not, I can't give you any money. See, that is why I'm passionate. That's why I'm excited. That's why I'm fearless. That's why, I don't care how much money I make, right? I don't care if I reach the finish line. I don't care if I really made it and become financially independent. It's not about me. It's not about my family. It's about others, right? Because at the end of the day, I want to build something that lasts a lot longer than just the current generation. I want to build a legacy, right? So with that, I hope you guys get what I'm saying, okay? There's just too many of these examples out there in real life that's waiting for your help, all right? That they either don't have living benefits or they have some deviated, I do apologize, messed up form of living benefits that your consumer will eventually find out in a time of need, which will be way too late. Way, way too late. Does that give you the ultimate energy to go fight for this? Does that not give you the ultimate energy and the reason to go out there and do it one more time, or do it 10 more times, or just absolutely keep doing it until majority of the world get converted into true living benefits? That's my reason, right? Will be more passionate than ever before. So here's just a list of claim checks in the past, just real quickly, just to show you, because we know there's a lot of new people on here. You don't know whether this is the real deal or not. You join the opportunity because you get excited, but as a person that's been there, done it, and still doing it, I'm letting you know these are as real as you can ever imagine. All right, this is 09 claim check, $235,000 out of a young guy that suffered leukemia. All right, make the claim check and still alive today. After like 11 years. You understand, right? This is another check, $288,000 to one of our PFA agents, a spouse. All right, and there's another one of our agents sold it to a young lady that had complications during pregnancy. Okay, got into critical illness, lost kidney function. All right, a little small claim check that helped her to tie her over for that period of time, right? This one, about $51,000, is one of my own that I help a client of mine who's self-employed that did not have health insurance at all because he couldn't afford it, right? And just put it that way. And he purchased the policy because of trusting me that this is able to pay out in case he got sick, which I delivered $51,000 in his hand within 45 days of period of time. Wrote me a nice recommendation letter. And this money, you know what she used the money for? She used this $51,000 to perform surgery for his colon cancer. Isn't that amazing? Look, I want you guys to put this into perspective, man. I want you guys to think about this, okay? Somebody is in life-threatening disease, okay? Cancer. All right, and they need to perform a surgery, and they don't have money. They don't have money because they don't have health insurance, right? And they come to you for help, and they're desperate and say, "Save me! I'm dying. I need the money. Please tell me what you sold me was indeed is going to deliver." And you delivered, and you gave him that money, and he go out there and perform a surgery. I don't know what you call that. I don't know if that's not a cause. What's bigger than that? If that doesn't get you excited and passionate, all right, and get a real reason to get back up again for those of you guys who hasn't been up for a little while, to do it again, to get so crazy about this opportunity to help more people, I don't know what will. So I just want to put that into perspective for you. Life-saving. 6-year-old girl diagnosed with brain tumor. Right? Deliver a $450,000 check. So she can go see the world. That is crazy. All right? 2 checks out here delivered to one of our PFA agent. Again, blindness. Right? These are real check, real life, real stories, real people. These are not actors and actresses. You understand? These videos are on YouTube's. Okay, these videos are on our carriers' websites. These are real life stories, guys. There's no makeup for things like that. You can't make up for things like that. All right? So, guys, I get emotional, get excited every time I talk about this because I find a reason, again, to continue to do what I do, what I love to do. You don't get tired of things that you love to do, you're passionate about, but you got to find a real reason. Money is one thing. But there's a lot more than just making money. But what would be better than making a lot of money by helping a lot of people? Would that be the ultimate? I guess so. So what makes our National Life Group one of our top carriers, very special? We have a lot of different choices. Of course, we're a broker. On this list right here, we have 1, 2, 3. We got 4 companies that we're going to get appointed with already. But why are we always talking about National Lide Group? Well, because they are the best of the best of the best, at least right now as I'm speaking, right? In January 11, 2020. All right. Now, tomorrow, if somebody comes up with a better product, I can't guarantee that, which is fine. We're a broker. We're going to do anything we want. We're going to get contract with anybody. But, guys, you know, we are with such an amazing company that I have been aligned with them since 2008. So now we're talking about 12 years later. This company is still delivering its promise, still innovating. They're still on the very top of their game, right? Their IUL sales is still the top 3 in the entire nation, right? I'm proud of that, okay? And you should be very proud of it too. And the rest of it, they're a good company, right? Some of them are even bigger company, okay? But they're just trend followers, in my opinion, right? They just follow the trend, which is fine, nothing wrong with that. But National Lide Group is the creator, okay? They're the one that designed and created living benefits. And I'm excited, you know, to be a representative of them and also a client of National Lide Group, because I know they're going to deliver. I know they will. They have delivered. They are delivering, and they will deliver. And they've been around for 170 some years, okay? Mutually owned. There are not a lot of companies out there can compete with that. All right, next let's talk about a serious issue. So we transition into another rider here. Another serious issue right here, we're talking about 170 million Americans today are either don't have life insurance coverage at all, or they are severely underinsured, like my dad when he passed away. Severely underinsured or no insurance at all. Approximately 50% of all residential real estate foreclosures are due to medical debts. Okay, and then 2 out of 4 households have filed personal bankruptcy due to medical problems. All right, you know, if money wasn't an issue and you have love for your family, you know, I think everybody would own millions and millions of dollars of life insurance, right? But the issue here are twofold, right? One is they can't afford it at that time. They got to work up to it. A lot of young couples are like that. A lot of people that are starting out having a job, they don't have a lot of money. They can only own a little bit of life insurance. But when they make more money, they can eventually buy more. But what's the problem about that approach? Well, when you buy more later on, you're buying at a later age. And when you buy at a later age, guess what, ladies and gentlemen? It's more expensive, right? Because life insurance costs more at older age. So that's problem number 1. Number 2 is, at later age, your health might not be the same as when you were younger. That's another bigger problem. So you know, nobody can control those kind of stuff, right? But with our gap protector rider, we resolve that issue, okay? What if you can't afford today what you need tomorrow? What if you have a gap in coverage? What if you need $1 million? You can only afford $250,000. You have a gap of $750,000, right? So our CEO and founder, David, is so ingenious, right, innovative, that brought in GPR into our IUL. It is exclusive to all PFA agents. No other agents in National Lide Group, unless they're coded under our organization, can sell this rider, period. That's the fact. So the GPR is ideal for those who need additional coverage, need to work up to afford it, like a lot of young couples, young people, all right? The amount of insurance coverage and its premium can be increased annually by preset amount. It does not create a new surrender charge period. That's good, all right? You don't have to qualify again regardless of the health issue. Wow, that is tremendous. That means that later on, if you get sick, you can still qualify. That's amazing. And the premium increase amount is the same every year, regardless of age. Now, let me repeat that. The premium increase amount due to the increase in face amount you purchase every year is the same every year, regardless of age. So what does that mean? What this means is that this gap protector rider, which is exclusive and proprietary to all of us, does 2 things, and does 2 things very specifically. 1, it locks in the rate at current age. For example, 30. That's just an example, okay? All right, not everybody's 30 on this call right here. Just you're 30, we lock in the rate at age 30, and second thing that it locks in is the health. You're 30 years old, we lock in the health today. So later on, when you're 35, 50, or whatever the age might be, whatever your health condition will be, we do not care about that. We still use your current issued age's health and the rate for underwriting. So what is the end result of this GPR? It saves you money, right? So compared to the first guy that don't have the GPR and assuming same health from age 30 to age 50, which is kind of hard to, to predict what someone's health is going to be in the next 20 years. But let's say the health is the same. And this guy is going to increase about 15% death benefit every year, which is about $37,500, and all the way to age 50. So $250 at $37,500 every year is going to eventually become $1 million. So it's going to pay more every year, and total in the next 20 years is going to end up paying about $182,094 in total premium without the GPR. The second line is with the GPR. And as you see, the premium is a lot less, only $113,647. And the reason why is because that client is paying the increase in face amount still at age 30 and still using the same health at age 30. Just imagine that you buy more insurance at age 50. You're going to pay a lot more than when you bought the same amount at age 30. Am I correct? But in our GPR, it doesn't matter how old you are. Now, of course, there's a cap on the age you can get the GPR. I'm not talking about that. I'm talking about when you purchase a little bit older age, you're still paying the same rate at issue time. So in this particular example, it's a $68,000 in savings. That's absolutely amazing, right? So again, it automatically increases the face amount of the policy on an annual basis by preset amount with no additional underwriting at time of increase. Doesn't matter what your health is going to be. Premium will also increase annually according to the face amount increase. Ideal for clients who know they will need additional coverage but need to work up to afford it. Annual percentage increase options 5, 10, 15%. And the rider increase under this rider is available all the way until 70. Okay? And of course, there's a limit on how much you can increase to, depending on the age. From 20 to 29, you can get maximum increase 4 times the lesser of $250,000 or your face amount at issue. At age 30 to 39, it's 3 times of that. At age 40 to 50, it's only 2 times of that. Okay, so these are the requirements. I point your attention to this book called The Blue Ocean Strategy by W. Chan Kim and Renee McBorgnick. All right, do apologize for that spelling pronunciation. But anyway, this book talking about how to create uncontested market space and make the competition irrelevant. And I want to point this out to you because, number one, if you haven't read this book and you're an entrepreneur, you ought to. It's a tremendous read, all right? It's an amazing strategy in this very competitive environment that we're living in. And number two, that reminds me of the Gap Protector Rider, the GPR, that I just shared with you. You know why? Because nobody else, unless they're a PFA appointed agent, can sell GPR inside an IUL right now as I'm speaking. Okay? Now that's very powerful. You don't compete, you dominate, because when your competitors don't have what you have. Okay? So that's our blue ocean strategy I want to point out. I'm excited about that. Let's talk about the next rider here. Additional Protection Benefits Rider, APB. Okay? Now this rider is used in a very competitive situation where the agent choose to lower the cost as much as possible so that they can perhaps compete with the non-competitive IULs out there. All right, so that's the reason for this APB. Okay, now I've used this occasionally. I don't use it very often. I do use it occasionally in an extremely competitive situation because most of the time I found that our policy will be able to compete with most of the carriers out there that are in the same space. But in very rare situations, I use it, and sometimes I kind of reserve to use it because anytime you add an APB, that amount is not fully acceleratable for living benefits purpose. Okay, it used to be only 50% of that is acceleratable, but now the good news is that the entire APB amount now can be accelerated for living benefits. Now, when I say the full amount can be accelerated, doesn't mean that you can get everything, okay? Keep in mind that the discount factor still applies. But now the entire amount is eligible for the acceleration, should I say, okay? And the ratio is 3 to 1, all right? Well, that's the ratio. You can't get more than that, all right? So I just want to talk about that. And there's no reason, why you on the field, in those rare situations that you come into an extremely competitive situation, you cannot use this APB to go and earn your client's business. Okay. Next one, this is automatic added for the states that have this rider, so there's really nothing to worry about. It's a waiver of surrender charge employment rider. You have to be a full-time employee. All right, a 1099 self-employed person doesn't count. Okay, so if you're full-time employed and then you lose your job, okay, so this is what it says: allows the insured to waive the surrender charge if the policy is being fully surrendered, as long as the following conditions are met. The surrender occurs while the insured is unemployed. Employment begins while the rider was in force. Unemployment has continued for at least 12 consecutive months. Okay, so you have to kind of be employed for 12 months. So it's a little something, nothing crazy, all right, but it's there for you. So what that means is that if the client is employed, they can't afford the policy anymore, if they cancel it, they don't get hit by a surrender charge. Okay, that's what it is. So again, there's nothing you need to worry about to use or not. It's already in the policy for the states that have this rider. Okay. Next one is a great one. Children's term rider is a great one, and I think in 2020, a lot of us ought to be using this a lot more. It's a fantastic way to get your children a little coverage with a very inexpensive fee rate. Okay, so the children's rider provides a term insurance on all the insured child until they reach 25 years old. Each child is covered for the same selected benefit amount. Children born or adopted after issue will be automatically covered as well. And the rider can be converted into a permanent IUL policy within 31 days of the insured's death. Okay, so it's got a lot of flexibility involved with it. The nice thing is that you only pay one cost for one child, and if you have multiple children, you don't pay more. That's the nice thing about it. Okay, so it really benefits people that have like 10 kids. You can just like add this rider to it. All 10 of them, as long as they're under 25, will be covered. Now the issued age has to be 15 days to 16 years. That's the issued age, and the maximum per child is $25,000 per child. Okay, and when they convert their policy into a permanent one, either at the death of the main holder or when they reach 25 years old, they can convert it into a permanent policy. The maximum conversion amount is $150,000. When I say convert, means that there is no medical underwriting needed. So that's a pretty cool rider. The next one is part of the policy. Rarely use it. That's why I highlighted in yellow. Very rarely use it. This is really designed for business planning. It's called a balance sheet benefit rider, BSB, where the policy is being used to fund the employees' benefit program. The reason that doesn't exist, guys, is because employees, they move around a lot. You understand, right? They don't stay with the same company. So they need a solution if an employee quit the job and they take the insurance policy with them, or cancel the policy, or whatever, then they don't get hit by a huge surrender and end up with nothing, right? So that's why it's there, so that to minimize the surrender value. And you can choose from 1% or 100% of the face amount to participate in this rider. It is a cost rider. You have to pay to get this. It's not free. So, typically I wouldn't worry about it for most of the client. These are long-term policies. You don't need to worry about surrender charge. I mean, life insurance is really for long-term anyway. Retirement planning, tax-free retirement is for long-term planning anyway, right? 10 years and above. But if you do it under some rare situations, keep in mind that your target premium and the commission you get paid will be severely reduced. Okay, and now you can contact PFA and NLG for details. The next one, it's called an overloan protection rider. It's automatically in there, but when you exercise it, you do have to pay for it. There's a cost rider. What this does is that it prevents you as a policy owner from over-loaning to yourself and then cause a policy to lapse. So for example, you may have $50,000 in your cash value and you got a $1 million death benefit. And without taking any money out, the policy is nice and cool, continue to fund it, everything looks great. But let's say you go into the policy, you take out $45,000, all right? And the policy could lapse very, very quickly. So what this rider does is that it sets the most you can take out as a loan, so it prevents the policy from lapsing, or at least lapsing right away, okay? I rarely use this, but it is there. For the policy in case you do want to exercise it. The next one, again, I don't really use it, but it's just for you to know it. All right, and again, all the things you highlighted yellow is the one that I rarely use it. Waiver a monthly deduction rider. What this does is that if the client becomes disabled, the insurance company is able to waive the monthly deductions, such as the expenses and the mortality charges for the client, okay, before they're 60 years old, okay? Now, this is only deduction waiver, all right? Deduction is just the expenses waiver, understand? So this does not mean that they will waive and still pay for the premium to go into the cash value. It's a totally different thing. So if you choose this waiver deduction, they only pay for the expenses, okay? So that means that if they pay for this, there's really nothing going into your cash value. It's not growing. So another rider that I personally rarely use, but you should probably know about it, is called the waiver of specified premium. Now, if you want to do this one, it'll cost more. And what this does is that you can specify, okay, you know what, I'm paying $10,000 a year. Now, of course, out of the $10,000, maybe $4,000 is expenses, $6,000 is going to cash value, so I'm doing $10,000. Then I want to buy this premium to make sure if I do become disabled, maybe my job, has a lot of risk and high risk, and I'm worried about it. If I do become disabled, I don't want the insurance company to just pay for my cost of insurance. I also want a policy to overfund it so that I can get retirement income, right? So you can specify, hey, I want $10,000 in premium should I become disabled. So that's what it is. I personally don't really use it, but it's good for you to at least know what it is, all right, especially the CFTs. Next one, charitable matching, gift death rider. This is a very nice one for those of you that have a charitable beneficiary, okay? And then NLG will match up to 2% of the face amount upon death. So if it's $1 million death benefit, client dies, they'll give you $20,000 extra, 2%. All right, if that's 2% of that, $20,000. So on top of the $1 million to your charity, and this is no cost. Okay, I like that. I really love what NLG is doing. And I really love their culture. It's always thinking about, always giving back, always serving the community by giving back. All right. Okay, well, this is the last part of the protection rider thing, and this is a very special one. It's called the GFR, Guaranteed Flexible Rider. And for this GFR, it is unique. It is a proprietary rider for PFA agents. And what this allows you to do is to add a secondary guarantee up to 40 years on the death benefit, depending on the age, of course. The first 10 years guarantee is free. You don't need to pay for it. But if you want a 20-year, 30-year, 40-year guaranteed, then you do have to pay for it. Okay? Now, no other IULs, or at least I would say a few IULs, has a no-lapse guarantee these days. Okay? Very, 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 very few. So for National Life Group, come out with this flexible rider guarantee and at least give you an option to add to up to 40 year. This is absolutely tremendous. So the way it works is that you got to look at your age of issued. Okay, from age 0 to 55. If you have a client that really concerns about, oh, you know what, I'm looking at the worst case scenario, the guarantee worst case scenario, the policy lapses at age 75. I know the scenario for that to happen is very unlikely, but I cannot sleep over it. Okay, Mr. Agent. So do you have something? Do you have a guaranteed death benefit, or can you sell me something that guarantees it's not going to lapse? So now it's your option now. So if they're 55, you can add a 40-year no lapse. For 40 plus 55 years old, so they can pretty much guarantee that death benefit no lapsing until 95 years old. Now, of course, different age is different period, so you got to watch out. It's not always like 95, but really depending on different age, what you add to it. But that's tremendous. At least now your client have the option to get that death benefit guaranteed, which we never had that option to do before. You know, the only other option we had before is to compromise the growth of the cash value and put the client into a whole life or a guaranteed universal life. In those products we sell, of course, that have living benefits, but of course you're going to compromise on the growth potential. So if the clients really, you know, they want the best of everything, they want, hey, you know, I want to maximize my retirement income. That's very important to me, but yet I do very concerned about, you know, policy lapsing. I can't sleep over it. Then this is your best solution. Then you don't have to change to a different product completely to satisfy that. You can just add a GPR up to 40 years to kind of get the best of all the worlds. Okay. Now the nice thing about GPR is that the client can drop this anytime too. Okay, they can add this to it this year when they issued, and then they can say, well, I don't want it anymore. After 10 years, I've been funding the policy very nicely. The interest rate environment's been great. Overfunded, I don't need to worry about this anymore. So you can also drop it if you don't think that you need it. Now, here is my opinion, okay? I put a big disclaimer at the bottom, and I put a big title here. It's my opinion, okay? Here's my opinion. Young people who have long funding period, typically I say under 40, you don't need it. My opinion. All right, and if you add something like that to it, you're wasting your money. You worry about your policy lapsing, you're truly wasting your money. Because all this IUL, you got to be funded properly anyway, right? And if you're young, you ought to be, hopefully, you're more growth oriented than just looking for guarantees, right? So for people that are young, looking for growth, you don't need this GGFR. Waste of money, in my opinion. Now, clients who overfund or max fund their IUL don't need it, all right? And again, you know, when you max fund and overfund the IUL, your IUL, you know, it's performing, should perform pretty well under, you know, of course, look back, you know, based on the history, there's no guarantee in future return, of course. I don't think you need it. Now, who needs it? And then there's a group of people that needs it. For people that's over 45 and worry about lapse of the policy before a certain age, they constantly worry. All right, they want the IUL, they love the tax-free retirement, they love the growth potential, you know, and no downside, loss of their money. They love all that, but then they don't understand. They don't want to give up the guarantee on a death benefit. And they don't want to go and convert to a whole life because whole life, the growth potential is not nearly as good as the IUL, or they don't want to go with the GUL because the growth potential sucks on the GUL, right? That is what it's for. It's for this group of people. And again, this is purely my opinion, which does not guarantee better or worse results. Do it at your own cost or your own risk. Okay, so that's my disclaimer right there. All right, now. I want to put this on there so that you'll be so confident going out on the field, even when you bump into other National Live Group agents who are not in PFA, you got to be aggressive. Okay, you got to know that you have the best of all the world. You can sell everything that other agent National Live Group can sell, but they don't have the gap protector rider, and they don't have the GFR guarantee flexible rider, but you do. You understand that? So use that to your favor, right? I mean, they have this that benefit protection period. Look at their 55 years old, up to 55. It's only 20 years, guys. All right, so there are no lapse on this. But for people that's very concerned about the IUL lapsing, it's only up to like 74 years old. You can add 40 years to 54. You can guarantee to what 94 versus their 74. So who wins? When you bump into a client that truly cares about guarantee. Look at this. 55 years old, they can only get 15 years. You can get 40 years. Now, of course, 56 is a different number, and so on. So you get my point. You get my point. Okay, so you have a huge advantage out there, even just within the National Life Group world. You should be the aggressor. You should be the one that turn the table around. Don't get instead of like trying to listen to what they have to say. You need to be aggressive and say, hey, I can do everything you do. All right, because you're appointed at National Life Group, I'm appointed with National Life Group. I can do everything you do. I can do more. Right, so that's a pretty powerful edge when you say unfair advantage for PFA agents. It's a good way. It's a good thing. Okay. All right. Now let's switch gears to the second part. Okay. Now, guys, just so you know, what I'm doing right now is being recorded, and this is going to be a new updated course on our Certified Field Training online class going forward. All right. So I encourage you to listen through to the end. So I still got about 30 minutes content. I know it's a little bit past the normal 1 hour, but I just got so much information in here that I want to finish the recording and give you the first time. So you listen to this the very first time. All right, get a first-hand advantage on this. Stay through it, and if not, then you'll be able to still catch the recording on JW app or the SEAL team as well. Okay. Now, so now the second part is on the cash accumulation, right? So that's my logic. The first part is all about protection, and now for the remaining, it's all about cash accumulation. Now, this is really for people that's rare. That's why why they buy IUL, right? Number one, they have the need for permanent life insurance policies. Number two, they want growth and they want retirement income, right? So those are two main reasons. So now let's talk about the second reasons. So talk about growth and cash accumulation. So one of the riders is called a premium deposit account, and this has been available now to our product, and it's a pretty cool thing. I say, I don't really use it much, but it is nice for people that need this kind of account. So who needs this kind of account? It's for client that tells you, hey Rex, I don't want to keep track of my annual payment on this policy. Yeah, you might do monthly automatic payment and all that. I don't want that. I don't want money to be taken out of my account. I want to give you a lump sum money one time, all right? And then you take good care of it, and then you automatically deduct money from this lump sum into my policy, so I don't have to worry about keeping accounting on it. So there's some clients out there like that, all right? But what's the problem about giving you a lump sum of money? You can map the policy. You can modify and endow the policy, as you know, because you can't put the big lump sum into the strategy, into the life insurance policy. Then you're mapping it, right, and it become a taxable event. You don't want that. So that is what the PDA is for, okay? The PDA earns interest, okay? So the interest earned are taxable. They're not tax-free, so they're outside of the policy, but it's kind of like a supplement, kind of tax to it for the time being, okay? And if you happen to cancel the policies or whatnot, the surrender charge is very minimum. It's the lesser of the interest of the PDA balance, percentage of the PDA balance or the interest earned. So the worst case scenario is that you don't keep your interest you earn if you cancel the account. So keep that in mind. Okay, cancel the life insurance policy. That's what I mean. All right. So this is how it works. So let's say you got a big account and the annual premium is $50,000 and you plan to fund this for 10 years. All right. For easy calculation, that's a $500,000 total premium. Without the premium deposit account, it's $500,000. But now, if you use this PDA, not only it's maybe easier for the client on accounting purposes, but you can actually save the money. All right, you can save them 8% in this scenario. So the total payment with the PDA is only $458,000 and change. So instead of paying $50,000 out of the client's pocket, using a PDA, the out-of-pocket save them $41,888. Now, how is it possible? Well, it's pretty simple. You are giving the insurance company $500,000 in this example. They put it in an account that earns interest. In this example, it earns 2%. Okay. Now, this 2% is just a generic rate. It's a hypothetical rate. Okay. In most states right now, it's 1.5%. In case you're wondering what the current rate is. Okay. In New York, I think it's still 2.2%. Okay. So you give them $500,000 right away. It earns a 2% interest, and therefore, there's interest earned, and that used to offset the payment they made into the account. That's basically what it is. That's the whole idea of it. Okay. So basically, the whole 10 years later, you made about $41,000 in interest. And that's basically what happened. Okay. But you do have to pay taxes on that, so it's really not $41,000 saving minus the taxes. But that's a neat little thing for people that have the money. They don't want to keep accounting on it, and they want to pay the policy even a cheaper way, a less expensive way. The next one is called systematic allocation rider. Now, this is a rider that I personally rarely used. Okay, that's why it's in yellow. Rarely use it, but it's the nice thing about this is it's designed for people who got a big lump sum rollover or a huge premium coming to the account. All right, so it's like your 1035 exchange account, a rollover account, so to speak. Now, why is that important? Well, think about this. If you roll over an account that got $200,000 from another policy, and the whole entire $200,000 hit your new IUL account just on one day without a systematic allocation. So now, this whole year, the next 12 months, is really relying on 12 months later, are you at a higher index value than that one single date? So you're putting all the risk on one day. Now, really, there's nothing really that risky about doing that. However, some people want to say, well, I got 200 grand. I don't want my risk to be on one day. In case the market is kind of fluctuating, goes up and down and stuff like that, maybe it's better off to lower the risk a little bit to just do dollar cost averaging. So this is an example of like what happens in dollar cost averaging because the market fluctuates. You put the same amount of money in there in the 5 months, and the sales price, start at $10, goes down and goes back up. So, you ended up paying at $8 per share on the average, right? So you ended up buying about 64.6 shares. Now, the same amount of money, $500, if you dump everything into 1 point when it was costing $10 in January, 500 divided by 10 is 50 shares, you understand? So you ended up much less shares, right? So that is the whole idea of a systematic allocation rider. Is it necessary? Yes and no. Is it always right to have a systematic rider when it comes to big money rolling in? Again, it's really depending on the client's risk tolerance and your experience as an agent to recommend it. Okay? And again, the best practice for you as an agent is you recommend it, all right? But you can never guarantee that dollar cost averaging will always become have a better results. So always try to give them options when it comes to things like that, because you don't want a client at the 12 months later they blame on you and say, gosh man, you told me to put everything in and I know there's this dollar cost averaging, I would do that because right now the market went down. Well, nobody knows what the market is going to do, right? So the market can go up too. If the market went straight up, doing this is worse. But if the market go down, doing this is better. right? So, so the whole idea here, guys, is it's just an option, and this is only used, guys, when you're talking about big rollover or 1035 exchange from another account. Enough said about that. All right, now let's go into something that's extremely interesting, and we're going to wrap this up because it comes down to a point that we need to talk about the retirement side of it, the cash accumulation. So at the end of the day, you want to buy an IUL because of what? Distribution, right? I mean, that's one of the main reasons. There are 4 different ways to get access to your cash value. Number 1 is your lifetime income benefit rider. Now, this is the most conservative way, yet it should be the way that you talk about, and this should be the way that you sell to your client on, all right? Because you always want to go with the most conservative way projections, and in hope for, you under-promise, and then you can what? Over-deliver, right? So this is how it works. So you must have the policy for minimum 10 years from time of issue, okay? You got to contribute adequately, of course. And you must be at least 60 years old in order for you to turn this option on. Minimum age is 60 years old. At 60 years old, minimum age, you can start to elect the income. And at that point, the insurance company will calculate a guaranteed level of income that's tax-free for the client based on how much cash accumulation they have accrued up to that point, and the death benefit amount, and the whole 9 yards. And this dotted green line, it represents the guaranteed lifetime income. The guaranteed lifetime income starts at the point of activation of income only, okay? And the client can live as long as they want. They will not run out income. So that's the nice thing about this, right? That's what's so cool about this thing. It basically turns into a guaranteed annuity. And at the end of their life, even if they use up all the death benefits, what do you mean by the, oh, I'm sorry, I take that back. They don't use any death benefit. The death benefit will go down proportionally as you take income out, because you have to reduce the death benefit in order for the policy to sustain, to not lapse. That make sense? So when you take income out, the death benefit will also go down proportionally, so that the policy will never lapse, so to speak. But even in the even if you take the income out for the next 20, 30, 40 years, 50 years, the minimum death benefit is still $15,000. That's reserved for burial, final expenses purposes, and also $1,000 cash value still remaining. Now that's really immaterial. Immaterial doesn't make much difference, but it's there for you. Okay, so it is automatically added. As long as you're age 0 to 75, cannot be exercised before 60 years old. We talk about it, and there's a ratio that they look at. Otherwise, you cannot start the rider if the cash value is too low, or if a client is rated too high. Minimum 10 years waiting period. Talk about that already. Now, what if you increase your face amount using gap rider? Does the 10-year keep starting, keep resetting? No. So that's a great thing for our GPR. So it does not reset the 10-year period on a GPR. What else is important on this thing, on this LIBR? Again, they look at your death benefit to your cash value ratio. Make sure the cash value is high enough. And guys, when you design your policy, just make sure you overfund these kind of policies. Just make sure you run the illustration thoroughly and using different interest rate, all right, to make sure that you're not going to bump into a situation where you cannot turn on the LIBR. Okay. What else? Benefits is not guaranteed until the LIBR is exercised. Okay, as I already said that earlier. Once you turn it on, then it's guaranteed. Are there any premium required? No premium is required anymore to the policy once the rider is exercised. Can the client stop and start the payment? The answer is yes, absolutely. They can start and go. They can stop and go. It's very, 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 very flexible. Okay? And they can even choose a level payout, okay, which is the maximum initial payout, or they can go with a increasing payout option, which start at a lower level initially and then steps up about 3% every year to in the hope to fight inflation. Okay, so that is your option 1. Option 2 is your wash loan. Wash loan is available at the starting the 11th year, which you can borrow money from your cash value. They charge you interest rate, but they will credit you back every dollar of interest that they charge you. So if they charge you 5%, they credit you back 5%. 5 minus 5 is what? 0. It's called wash loan. Now, if you do it before the 11th year, from year 1 to 10, then obviously there's a net interest that you have to pay. Okay, so typically you don't want to do that in the first 10 years of your policy. And then the third and fourth option is really, what we call the variable loan option. But right now they introduced the fourth one. In the world of variable loan option, it's a great option if you feel that the market is continuing to perform, continue to earn the interest, the 6 to 7%, and you want your money to continue to earn interest when you take the money out. So that's the world of variable loan. Creates an arbitrage. It basically allow you to take the income out, the maximum amount of income for a long period of time. Now, but it's not guaranteed, as you know, right? Because the interest rate environment is not guaranteed, and also the S&P 500 environment is also not guaranteed. But that's where option 4 comes into place, is that at least they'll guarantee the interest rate environment to lock in that variable loan, so that the loan rate that you took it out will never change anymore. So it just kind of reduces the risk, take the extra layer of risk out of the environment. Now, it's not always good, okay? So you gotta be understanding is that, well, all these things, what is good, what's not good, is that the variable loan in general is good for people that expect the market is going to continue to do good. Now, but if you do a participating fixed loan, so to speak, is a subset of their variable loan. What the problem is that if the variable rate goes down, your rate is not going to go down because you locked it in. So keep that in mind. All right. Now, typically out of these 4 options, I tell you on the field, I only use 2 options. I use the LIBR, guarantee, most conservative option, and I want to show the client the last one, the variable loan with the fixed loan rate, to show the client what is possible. Okay, so that's your distribution options right there. Those are the 4 options. 2 and 3, 3 and 4 pretty much illustrate the same way on your computer. So it really doesn't matter which one you use on your illustration. I never really use 2 on any of my illustrations. I never use that. All right. So I either use 1 or variable loan. All right. Okay. The last part here has to do with the way you make money, the way you earn interest. Okay, on your cash in here, and then we're going to wrap this up in about 10 minutes in here. So you got total 6 crediting strategy. You got the fixed, and you got the Credit Suisse point to point, and you got 3 S&P 500, and the last one is Hang Seng. So total 6 strategies in here. All right, so let me go into a little bit more depth on this so you can really understand it. Now, good news is that right now, all the strategy besides the fixed interest strategy is point to point. Very easy to understand now. Okay, very easy to understand. So just point to point. I'm going to explain in just a second. Another good news is that now, in addition to the S&P 500, we've also introduced the Credit Suisse and also the Hang Seng. So why? All right. Well, first and foremost, we're all very familiar with the S&P 500, right? There are 3 strategies in here, which I'm going to go into depth, but the S&P is obviously the most commonly used index throughout the IUL world. Any insurance company you go to, they use S&P 500. Okay. And then you got the Credit Suisse is more of a hedger. All right. That basically when things go up, it doesn't go up as high as the best scenario. When things go down or go really bad, it doesn't go down or get worse as the worst case scenario. So it's kind of like in the medium, kind of like hedging against the best of the of both worlds, kind of conservative option. And of course, you got the Hang Seng. The reason we is there is so that you can expose some of your money into the Asian countries, especially in China and Hong Kong. So here's your 6 strategies, right? 1 through 6. The first one is just a fixed 3%, fixed for 1 year. So let's kind of talk about 2 to 6. What are these are? Okay. So first and foremost, let's talk about this point-to-point strategy in here. How does it work? So you are not actually directly investing in the market, all right, or participating in any stock. So you're not buying stocks. So make sure you understand that, all right. Your client put the premium in there, minus the costs and expenses. The rest of it goes straight to the cash value. Your rate of return of the credits is tied to the index, either the S&P 500 or the Hang Seng or the Credit Suisse. Changes in index are used as a measurement to determine how much interest you get for that particular year, based on floor, cap, participation rate, and which index you choose. So cap is the maximum you can earn for that year. Floor is the minimum you can earn for that year. Participation is how much of the upside are you getting for that year. So that's the best definitions I can give you on the cap, the maximum you can earn, floor, the minimum you can earn, and then how much of the upside you can earn is called a participation rate. So here's how it works. All right. So your starting index value comparing to the ending index value 12 months later creates a difference. And they calculate it into a percentage using the following formula. Pretty simple, right? End value minus beginning value divided by the beginning value times 100, that's the percentage and change. If the percentage change is positive, they times that by a participation rate, whether it's 100% or something higher than that. And if the result is greater than the cap, because that's maximum, then the interest is credited up to the cap. Now, however, the positive change times the participation rate is less than the cap, then the interest is credited based on the change in the index value and the participation rate. Now, if the change is minus, sometimes it's minus, sometimes the end value is less than the beginning value, if the market went down, then the guarantee floor of 0% or 1% credited will be exercised, depending on which strategies you picked for your policy. So here's a real example right here, point-to-point example. So you got a starting value, hypothetical example, January 14, 2020 this year. Oh, by the way, every 14 day, the 14th day of each month, that's when they move the money into the strategy. And let's say on that day, the S&P is 1,300. 12 months later, on January 14, 2021, it becomes 1,400. How much interest in percentage did I just get? 1,400 minus 1,300 is 100, divided by the original, times 100 is 7.7%. Let's assume the participation rate is 130%, because that's the strategy you picked. 7.7 times 1.3 is 10.78%, but the cap is only 9.25. So you're not going to get 10.75, you end up getting 9.25, okay? But that is how it works. And if you understand this chart, guys, you understand exactly how all these index strategies work. Okay? So here are the 6 strategies. Historic rate of return. The red ones are the new ones they introduced. The green ones is the original ones they have. The question is that which one is the right one for you and your clients? And I'm going to give you an example, guys. Okay, now I'm going to give you my opinion. All right. So you can go online, go to National Live Group, and you can download this thing, and they will tell you the rate, and they will tell you the cap. Right. The point-to-point cap focus is 9.75. This one is up to 7.25, not as high as the cap, but then you know what? The participation rate is much higher, and so on. And so Hang Seng got the highest cap, 11.25%. Credit Suisse has no cap and a very, very high participation, right? So how do you decide? Now, I'll give you my opinion. I decide usually based on historic rate return. All right, I can only based on what had happened in the past. I can't tell what's going on in the future, but I can gauge what happened in the past 20 years and pick the one that has performed the best and hope it will continue to perform the best in the next 20 years, although there's no guaranteed. It makes sense to you, all right? So here is a sample allocation, and I'm giving you some logic to it too. I put 5% in the fixed. Well, Rex, why do you put 5% on fixed when it's the fixed rate only pays about 3% right now? Well, because I want my client to have a bragging right, or me have a bragging right, when the market tanked and everybody gets losing money, or most people who are in IUL that doesn't lose money, we have the bragging right to say, see, you're still earning interest. Now, that's pretty cool. All right, that put a happy face and a smile on your client's face, doesn't it? And I expose some of my money 10% into the Asian countries, about 10%, not more than that for me. And I put about 20% in Credit Suisse. All right, I like the kind of like the hedging thing, you know, not too aggressive, not too, you know, when it goes down, it doesn't go down as much. And then I like the no cap and the high participation of the Credit Suisse. And I put majority of the money because I believe in the United States stock. I believe in the economy. I put majority into the S&P. And I want my cap as high as possible because this strategy historically has outperformed, all right? So this is one way to do it. Is it the right way? There's no right or wrong. The above allocation is just a sample. It doesn't imply this is the best allocation. I just give you my logic. You might have your own logic. And as a matter of fact, there's no right or wrong allocations. There's no one, not even Warren Buffett, can predict the future. So just choose based on the client's risk tolerance. And the way you can do that, you know, to make it really, really simple, you know, you can follow this, all right? Or you can just dump everything into the S&P. It's completely entirely up to you. But one thing I do want to warn against you is, you know, if you're going to come into an IUL, please do not put majority of your money into the fixed strategy. Your policy will significantly outperform in the long run if you put majority of your allocation into fixed. That's not the reason you come into an IUL, by the way. Okay, let's talk about the enhancers to wrap up today's training, guys. Now, the enhancers, if the policy is less than $1 million, very simple. You don't have any other choices. You got a pretty nice feature called the accumulation value enhancement rider. No cost. They give you 10% bonus. All right, starting the year number 6. And every year after that, as long as you earn interest, they give you 10% on top of that, as long as it doesn't exceed 0.75% of the accumulation value for that segment. What does that mean? For example, $10,000 accumulation value in year number 6. And let's say the market's at 10%. Based on the strategy you pick, it did a very, very good that year, 10% earning. So you earn $1,000, right? Because of this rider and no cost, it's automatically inside a policy, they give you 10% more. So 10% of the interest you earn is $100, because 10% of 1,000 is 100, right? Story is not done yet, because you cannot get over 0.75% at the maximum cap. So that's $75, because 0.75 of 10 grand is $75. So you can get 10,000 interest, which you earn from the strategy, and $75 from the bonus. Ended up at $1,075 in credit interest. So your final value for that year become $11,075. Or if you turn to percentage-wise, you earn 10.75%, just because you hold a policy until the 6 years, just because you have this free rider build-up. So very easy for you, for the agent, for the client. Nothing you need to do. This is automatically built in. Do you like that? I love that. Now, as for the policy that's $1 million and above, that gets a little bit complicated, but still, I'm going to give you my opinion, okay, to simplify things for you. So anything above $1 million, you have 3 options. You have the free one, it's called an enhancer. You have the 2-cost one, One's called the Enhancer Plus, one is called the Enhancer Max. So by looking at this graph, pretty much you can tell the free one, I like the fact that it's free, but of course it's got the lowest bonus growth potential. If you're willing to pay 1%, you have a higher growth bonus potential, and if you're willing to pay the maximum, which is 3%, you're going to have the maximum bonus growth potential. All right? So again, no risk, no gain. You know, there's no free lunch. You want it for free? Well, you're still getting a bonus, but just not as high. All right? Now, the nice thing about this enhancer, the client can kind of change it up this year. Oh, you know, if I think the market's going to do really good, I'm gonna buy the Enhancer Max, right? Oh, if I think the market's going to go down, you know, I'm not going to go with the Enhancer Max because I don't want to go negative. I give you my opinion at the end. That's not a wise thing to do when it comes to IUL, right? But let's see an example on how it works again. So for the free enhancer, you can't get above 1% as the maximum bonus, but you're getting 15% on top interest you earn starting the second year. So for example, you got $10,000 in the second year in your IUL. Let's assume the market did 10% earning. That's $1,000 in interest. $1,000 in interest, a bonus 15%, $150, but it capped it at 1%, which is $100. Therefore, you get credit total of $1,000 plus the maximum $100, $1,100 for the year. You add it to the original value, you end up with $11,100. So instead of getting 10%, you just got 11% interest because of a free enhancer. That's not a bad deal. That's pretty cool. That's pretty exciting. No charge. Automatically done for you, for your client. Nothing to think about. Good. Now, for those of you guys who are a little bit more aggressive, if you want to do the plus, you do have to pay a 1% fee. If you have a $10,000 accumulation value in year 2, 1% fee in that year is what? $100. So you got to subtract that from your accumulation value. And now you end up with what? $9,900. Assuming the same rate of return of 10% is $999. I'm sorry, $990. And it's a 35% bonus this time, give you $346.50. But it cannot be more than 3% of $9,900. So it cannot be more than $297. Fine, you add it to your initial interest, $990 plus $297. Total interest credit is $1,287. But on to the original $990, you ended up with $11,187. So instead of getting a 10% credit because you're willing to pay this 1%, you're getting 11.87% using the plus. And on the max, same kind of calculation. Not going to go through each line, but let's say, and by the way, the max is the most complicated because it depends on how long you have the policy. The first 20 years is 3% charge. And then 20 years, 21 years, or 30 years, a 2% charge, less bonus, and 31st years and above is the 1% charge, back to 35% bonus. But let's just take an example of the second year. Again, assuming a 10% earning, you're going to be ending up earning quite a bit more interest, $1,649 added to the value. You are at 13.49% on that year instead of a 10% for the year. So that's a huge plus. Now, I've told you all the great things about the enhancers, but let me tell you a little bit about the negative things. All right, that's pros and cons. That's why you're on this training tonight, is to understand the product thoroughly, right? So anything the pay version is not always good. All right, you could end up worse if you do the pay version if the market does not perform. So what if the market only did 0%? All right, this year, you know, you got $10,000 in a value. You pay your max enhancer fee of 3%. You end up with $9,700. The market didn't do anything. Now, if it didn't do anything, it multiplied by 85% is still nothing. Nothing is nothing, right? So in this example right here, you know, you are not earning any interest, so that your final value by having this enhancer max is actually backwards, 9,700. So instead of like 0% credit, like 0 is hero, you got a negative 3% using the Enhancer Max, ladies and gentlemen. So it's not always good. Interesting, huh? So why am I telling you this? So that you can disclose this to your client properly. So that you can basically share with the client a very powerful enhancement on the cash value, but also disclose the risks to the client. Because the last thing you want is the client comes back to you a year from now and says, what in the world is this $5,000 charge and I've got zero bonus? Well, now you have it. This is the reason why, because you disclosed it. You understand? So get to one last step. The most detailed step is that, so what is the break-even point, Rex? You know, I show you a 10% rate of return. Fantastic, amazing. Enhancer Max is the way to go. And I said I'll show you a 0% rate of return. Then Enhancer Max will actually, you know, deteriorate your value. So what's the break-even point? Here it is. All right, I took the liberty to go out there and plot our very nice chart here. All right. And what this chart tells you is that is comparing the blue line, which is the one that does not have the paid enhancer. It just got the free one. The blue one is the free one, okay? No charge. You still got bonuses starting second year. The orange one is the plus, and the gray one is the max, all right? Now, so the break-even point is where the line crosses. Okay, so instead of like going into too much detail, let me point it out right out to you. If you're buying a max, that is the break-even point. If you're buying a max, as long as the interest rate for that year, for that segment, is right between 4.5 to 5, which is probably about 4.7%, you are better off having a max enhancer. Okay, you're good. You've done good. Now, if the market did less than 4.7 or lower, then you're better off to have the free one. You understand? And on the plus, the break-even point is a little bit higher. It's about 5.5%. And here is your summary. The Enhancer Max, the break-even point, anything higher than 4.7%, you're better off with the Max Enhancer. And for the plus, it's 5.5, okay? So the question for you as an agent, as a CFT, and as a client to decide whether you should have the max or not is really ask yourself this question. Do you believe that the S&P 500 will average out at least 4.7% year over year? If the answer is no, you should not have the max. All right? If the answer is absolutely without a doubt, then you should have it. And just that simple, ladies and gentlemen. So the whole point here is that I'm giving you the knowledge here so that you can full disclose this great, amazing enhancement to the client's cash value, but also disclose properly the risk involved with it. Now, here is my $1 million opinion. Now, you can take it as $1 million or you can take it as a penny. It's entirely up to you, but I'm giving it to you. But I'm holding zero responsibility to that because it does not guarantee better or worse results. Now, here's my opinion. Don't worry about a plus. Forget about a plus. All right, the plus to me, it has a higher break-even point, doesn't do anything for me. You're either going to take the free one or take the max one. If you're aggressive, go with the max. If you're conservative, go with the free. Simple as that. Okay? Now, make sure you overfund or max fund the policy before you even consider to do the pay option so that you can lower the cost ratio, all right, and thus lowering the risk of underperforming. So the whole idea of this bullet point is that when the market does good and because you overfund and max fund it, you earn a lot more interest. So that you use that money that you earn a lot more at a good time to pay when it's a bad time. That's the whole logic to that. Okay, so you really ought to be overfunding this kind of policies. Number 3, do not try to time the market by taking the enhancer plus or max in and out. and try to time it because you believe 2020 is going to go a certain way. You believe 2021 is going a certain way. And you're crazy and naive enough to advise your client, trust me, this year's going to be good. Let's do the max. No, 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 no. You're not genie in the bottle. We're not genies. You understand? You know, Warren Buffett can't tell the market. All right? The best thing you can do is to give them the option. Let them choose. But once they choose, stick with it. If you choose Enhancer Max because you believe you're very aggressive, stick with it throughout the entire policy. That is absolutely my opinion. All right? And again, this is just something that I want to share with you and hopefully can add some value to your practice on the field. Does not guarantee better or worse results. So do it at your own risk. With a smiley face, of course. Okay? Finally, guys, the minimum interest guarantee is 0.1%. It's really immaterial on that one. And hold on one second here. I'm wrapping this up, so I want to make sure you guys can still hear me here real good. Okay. All right, guys. And of course, when you do a policy that's $1 million and above, the chargeback, because with all these new excited enhancements and features, and for example, the free rider give you an extra 15% bonus starting the second year, right? And all those things, you know, there's cost involved, so that the chargeback period is up to 2 years if you sell a policy that's over $1 million or more. Okay, but this is not even a concern for the field, you know, as long as you, you know, sell the client the right reason. You know, they bought the policy, they understand the policy. I would not even worry about that at all. Okay. And lastly, in banding, just like buying stuff from Costco, you know, there's a reason that you buy stuff in Costco it's cheaper because you buy a bulk, right? So the face amount has bands, and the more face amount you buy, the cheaper it is as well, right? So instead of like getting a $250,000 face amount, if you get $250,001, it's actually a better pricing, and so on and so forth. So kind of understand this, but without getting into all the details of this analysis, I just want to give you a chart to help the field. All right. So I want to make it very simple for you. If your face amount is under $1 million, you know, there's nothing you need to do. Okay. Any face amount is under $1 million, $999,999. All right. You just do it the usual thing, run your illustration, sell the client, and you're going to be doing the best job for your client. Now, what you need to be a little bit concerned about is when you are at $1 million exactly, okay, or above. Now, let's talk about when you're $1 million exactly. When your client needs $1 million, do not give them $1 million if they cannot max fund it. If they just do target, you know. And again, here's the age difference. Under 15 years old, you know, use $1 million face amount. That's fine. But when they're between 16 to 49, do 999,999 because that's gives you the best pricing for your consumers. And anything above 50 years and higher, then use $1 million. Now, it sounds crazy. It sounds like, what the heck is this? I'm just trying to help you to do the best thing for the consumers because clients are #1 assets. In addition to the agents, so I'm just protecting you and making sure that you're always doing the best thing for your clients out on the field. You know, what's going on in this living life by design is that it's got 3 products merged into one. That's the reason we have to do something extra. All right? Everybody else, you know, outside of PFA, if they want to do this, they have to sell this product. They want to do that, they have to sell product B. They want to achieve death benefit guarantee, they got to sell C. They want to achieve a maximum cash flow in retirement, they got to sell D. They want to do that, you know. So they have all this kinds of product to play around with. You in PFA, just one product, makes your life simple. But because of that, you just got to watch a little bit extra on this fine little details, so that, you know, to you it's not going to make a difference, but to your client it will. And you can take this snapshot, okay,
And you can play around on your illustration. If you say, what the heck is Rex Wu talking about? Let me try to prove him wrong. Let me try to prove him right. That's fine. Always double check. Okay, I'm not saying that this is always going to be right. Okay, I cannot guarantee it. That's why I have a disclosure right here. But you can double check and verify it with your own illustration. For face amount that's above $1 million and no max funding. Now we're talking about no enhancer, just the plain vanilla. Under 15, one policy from age 16 to 49. You do have to split the policy and keep the policy under 9999999. And if they're over 50 years old, then just one policy. Sorry if it's a little bit more confusing for you, but again, this is in depth, so I want you to have this information. Okay, and if you want to double validate it, please do so. And if you find anything that's different than this chart, let your QFD know, let your EFD know, right? Let me know. I say, hey, maybe some of these things is not correct, and I've validated this with many of our top CFTs on our team to put this out there to help you guys. Okay. All right, guys. So with that being said, we've covered every single one of the riders today. We've covered all the protection riders, all the communications riders, guys. The only thing we did not do tonight is the illustrations, and that is going to be a totally different trainings because of time. Okay, guys, so we talk about all this premium deposit account, additional, all these things, and now you should not have any questions anymore. And if you do, you can always refer back to this recording and review it over and over and over and over again. I hope you guys are ready to dominate 2020, okay, because I am, and I know a lot of you leaders are. All right, guys, so to wrap up, guys, in addition to all this recording, will be in JW app and our SEAL Team Training website. I just want to remind you that the Just Win Mastery online class will be rolling out in the first quarter of this year. One of the most exciting launch in the entire PFA organization by executive chairman, and this will be at zero additional charge, no cost to all the current JW app paid version of the subscribers, before Jack changes his mind, of course, okay? So if you're not on the app, if you haven't done so, try it out. We brought back the monthly option back, so you can try it out, see if you like it. There's no commitment. So we do that for a lot of people that wasn't sure about the app and what it can do for you and your business, okay? So go download it today. Go to your app store, type in Just Win, and look for this logo. Download it, try the free version, and try the paid version, or whatever you want to do, okay? And lastly, guys, register for 2020 New Orleans Convention. This is our New Year's kickoff. A lot of bombshell will be announced, and you and your team don't want to miss it. And this is how you're going to start your year 2020 the right way. So, guys, that's all the time I have. I hope you learned something today. I hope this was a valuable experience for you, even though it did take a long time, longer than usual. But it is needed because it's the beginning of the year. I want to make sure that you have the right knowledge, the right information, so that you can go out there and have all the confidence to serve your client and your team the right way. With that being said, guys, God bless you. God bless PFA. Thank you. Happy New Year.